So if you have watched your TSP at all, whether it's in the last few weeks or even the last 5 months, the entirety of 2020 so far, I'm sure you would have noticed that things have been rocky, right? Things have not been super smooth. Things have been going down, and people are wondering, like, wow, why is this happening? What can I do to make sure that I'm still going to be able to retire? Today, we're going to talk about why it's happening, why it has always happened, and how you as a federal employee can prepare so that it's not going to mess up your retirement plans. You're still going to be able to retire the way that you want when you want. So if you are new here, my name is Dallin Hawes, a financial planner serving you guys as federal employees, and I absolutely love helping federal employees, whether it's one-on-one in my consultations that I do all the time, and you could book that down below if you'd like to, but also via the YouTube channel where I'm able to share tons of things to help you guys prepare to get the most out of your federal benefits. So we're going to dive right in. Again, we're talking about the TSP today. And right now, what I'm sharing today is what the market has done in the last months. Now, when I say market, what I'm actually talking about is the S&P 500. Well, what the heck is that? Well, in TSP language, the S&P 500 is actually the C fund. The C fund is tied to the S&P 500. So that's what I'm talking about, the C fund when I'm talking about the market. Now, I know there's other funds. There's the S fund, there's the I fund, there's the G fund, the F fund. But for the purpose of this video, the G fund and the F fund are bond funds, and I'm not going to talk about those today. I'm going to really be focused on stock-based funds, and in particular, the C fund, which is the most popular of them. So again, the C funds had some rocky times, and the S fund and the I fund as well, where things, and I'm going to be sharing my screen, so if you're on the podcast, this is a big one where it may be super helpful to be able to see the chart, see how things have worked over the last few months. So as we can see, over the last even just 5 days, the C fund has lost almost 5%, has gone down 5%, which is scary. And as people are retiring, like, wow, I hate to lose money. It's no fun, right? Okay, let's look at the last month. Okay, the last month, even worse. In the last month, we've lost 10%. Oh my goodness, right? 10%. Okay, let's look back even more. Okay, 6 months. Okay, in the last 6 months, we've lost about 14%. Just a lot of red, does not look good. Well, let's look back at 1 year. Okay, well, if we look back at 1 year, from about a year ago, the market's only down 3.5%, 4%, right in there. Well, okay, that doesn't look too bad, right? Well, what if we take it one step further? What if we look at the last 5 years? What does that look like? Well, when we look at 5 years, well, things actually look pretty dang good. So, again, if you're on the podcast, you won't see this, but on the YouTube channel, you'll see that over the last 5 years, even with how far the TSP has dropped in the last 5 months, you have still grown by 67% over the last 5 years. That's huge, massive. And we're not even close to the place we were at when the market dropped in 2020 when COVID hit. And that was just a couple years ago. We're not even close to that point, right? So the reason I want to share this is to give perspective. To say, oh yes, it is scary. It is scary to see things go down at all. But we have to keep in mind perspective where 5 years is not really that long of a time in investing terms. But even when we just zoom back 5 years, what's happened right now, it looks like, wow, that's kind of a blip on the screen. That's not much at all. And not just that, but what we see right now that's happening is not that unexpected. Where we see it has happened a lot, right? We saw it happen in 2020 when COVID hit, when people freaked out, right? And recently, of course, there's been the war that's freaked people out. There's been inflation, which has freaked people out. Interest rates are rising, which has freaked people out. So the market is going to feel that. Now, we don't know what the future is going to hold. We don't know, especially the short term, we don't know how people are going to react and what the stock market's going to do. But let me ask you this. Are people going to stop innovating? Think about it. Think about 30 years ago. What kind of technology were we using? Right? Think about a CD player. Think about the stuff we were using only 20, 30 years ago. Think about now. How far have things come? Is technology, are companies going to stop innovating, stop growing, right? And if you said, yeah, that's going to slow down, that's going to stop, that's not going to continue, then maybe investing is kind of tough, where it's like, well, things are not going to get better, But my perspective is, hey, look, in the short term, yes, the market is going to go up and down, definitely. But over time, when you invest in something like the C fund, you're investing in companies, right? And when we invest for the long term, we're saying, hey, in the short term, who knows what's going to spook people? But in the long term, I know companies are going to continue to innovate. They're going to continue to grow. They're going to continue to get better. And when that happens, the stock market's going to go up. Things are going to improve as these companies grow and get better. And so when we zoom out, things look great. Things look amazing. So as you get scared, when things go up and down, especially if you're approaching retirement, I beg of you, take a step back and say, okay, I know it is no fun to see your TSP go down. I know, I get it. But take a step back. Say, okay, what does this mean for my retirement? Do I have a plan that works even when the market goes up and down? Because guess what? The market does go up and down, period, done. It does. A weird thing would be if it never went down, because that's just not how it works. We have to expect it to go down. It's just a matter of when. You have to expect it and you have to have a plan. Now, I'm not going to dig into it super deep. I'm going to put a couple links in the description below to go into this deeper if you want to. But basically, there's a strategy you can use going into retirement so that you have your short-term money tied up. So guess what? Here's the deal. Like I said, in the short term, who knows what the stock market's going to do? We don't know. So that is why you need the short-term money you're going to need in retirement, because guess what? When you're retired, you may need some of your TSP. You may need some money to live off of. Great. Let's take that money you're going to need in the short term. Let's make that safe so it doesn't bounce up and down. But at the same time, long-term money we don't need for some time. Hey, we don't like it bouncing up and down, but guess what? That's the only way to get the growth we need to beat inflation, to make sure that your money lasts as long as you do and can help you maintain your standard of living over time. So again, I beg of you, the thesis of this entire video is take a step back. Things are going to be okay. You have to have a plan for things that are going to go down because it's going to go down. That is just part of the course. That's just part of it. You have to have a plan for when it happens. So if you have any comments or you have found a strategy or a way to think about all this to help you stay in the game when the market goes down, put in the comments below. Please share with the entire community so that we can all get better, improve, and go from there. So I hope that's helpful. If you're new here, again, my name is Dallin Hawes. I love helping federal employees get the most out of their benefits. Consider joining the community and subscribing. You will not regret it. Have a great rest of your day. We'll talk soon.